We are now in model number 3, and thank you for joining us here once again. In this setting, I want us to position our minds so that we can examine option components. Yes, you heard that correctly. Option components. And not only just the components, but also the mechanism by which they operate. So, in our realm, we'll consider this to be decoding the option chain, understanding what drives value, and how to interpret market signals. So, at the end of this session, I want us to have a grasp and be able to read, to interpret the option chain. I want us to understand and differentiate between the intrinsic value and the extrinsic value. So intrinsic inside, extrinsic outside value. All right, so this is in relation to the option. Then I want you to bear in mind what we will consider to be the bid, ask, spread, and volume. Not only that, the open interest and understanding what they mean and how they affect the trade as a whole. Because if we are in a trade and the trade is not moving in our direction, then we are at a disadvantage. So we have to be very mindful of that. And we're going to get into some real world application, and we're going to use some real world examples such as SOFI and APLD to apply these mechanisms so as you can see exactly what is taking place. And as you know, we are biblical people. So we focus our principles based on the Bible so that we have some biblical clarity, so that we can utilize the Bible in a meaningful way in our everyday life. So the principles we'll be engaging in will give us a clarity. It will allow us to be vigilant. It will give us wisdom in our decision making as we engage in this simple but complex instrument. So now, let us get into the meat of the matter of the meat that you came here to devour. Let us go into our mind's eye and think to yourself, what could be an option chain? Well, an option chain or option matrix is effectively the menu board. So you go into a restaurant and they have lamb chops, lamb splits, lamb slices, all these kind of lambs, all right? So this is basically the menu board of available option for a given underlying stock. It lists all the different contracts by their expiration date. We also have the strike price. We also have the call or the put, and it shows key metrics like the premium, the ask bid, the volume, and the open interest. Yes, the open interest is important when it comes on to options. So key columns you'll typically see, as we had alluded to in our last sitting, were the expiration date. Let me initiate a recording sequence so that you can see exactly what I am seeing in this moment of our conversation. All right, so we're going to engage in a recording sequence. Now that the recording sequence has been activated, let us get into an actual option chain. So the first thing we want to do is to click on one of our accounts, and the accounts that we're going to click on is the Webull account. In this section of our discourse, then we're going to go into the market, and then we're going to search for, let's say, SoFi, because you know SoFi is one of our favorite companies in 2025. Now, we are seeing the trade and the option section. Let us click on the option section, and it brings up the option menu. And with this menu, we can see first of all, we can see the option dates, the date when they will expire. In the center, it tells us the days that are left on these various positions. And we can select whether we want to see calls or put or both, but we tend to want to see both so we can make a logical and rational decision in determining if it is favorable. So let us get into it. So we see the expiration dates along the left side, and depend on what platform you're using, it may be a little bit different, but we're teaching from the Webull and the Moomooo apps, all right? So now it is about 6:23 a.m. The market will open by 6:30. So based on that idea, some of the values in the call and ask and bid section have been cleared out. So all of yesterday that has not been filled or that has been filled have been cleared out. So we're starting basically afresh today. So this is where we are and what we have to look at. So now we have in the center where we have the number of days left, we can see the prices in dollar figures, and that there would be the strike price that we are expecting the particular option to reach. All right, and then on your right hand side, let me just put it up so we can see it by itself. That there would be our put section. So these are saying that the market needs to go down. I think the market is going to go down. All right, if you're buying. The call section indicates that the market is going to go up. All right, and you just see that the price, the strike price, is on the other side. So now when you select one, let's enter our password, it shows you the list price or the limit price. All right, and it shows you the ask and bid that is cleared out at this time. But once the market gets open, then we will see what the prices are. But the limit price is the price that it had in the last sitting. All right, so that is what it is saying right at this moment. So changes from the previous day, the volume, the contract traded today would be indicated by the volume. All right, so we have different things. So volume is 0. If we look, it's saying volume is 0. That is because nothing has been traded in this moment. Then we move into the open interest. So sometimes people have put on position waiting for them to be filled whenever the price reaches their strike or their cost basis or the premium that they want to pay. So when that happens, if you already set that up in your system, then you will have a state in which there is an open interest, there's a desire to buy at a particular price when it can be agreed upon. So that there is the open interest, the contracts which are outstanding. Now, we have something called IV, which is possible implied volatility. And then we have the Greeks. All right, so let us see if we can put a back boat so we can see the big picture. And then we have open interest. And as we scroll to the right or the left, everything scrolls in the same manner. All right, so implied impl dot vol is the same thing as implied volatility. Then we have the Greeks, we have the delta, the theta, the gamma, and we have quite a few, but those we'll get into at another junction. So these are just some things that I want you to bear in mind as we examine the market sentiments. And in understanding what is happening, we are better positioned to plan for the future. So let us give an example using SoFi or APLD. So for SoFi, let's hypothetically say SoFi, you can view its option chain on Webull, which we just did, And we can also go to, let's go into Moomooo. Let's go into Moomooo. So click on Moomooo, and we're now into Moomooo, and we're going to go into the watch list. We're going to look for SoFi, and if it's not there, if you haven't created your watch list just yet, what you can do is just in the search bar type in the particular stock, SOFI, and it comes up. And in the same manner as the last platform, the Webull platform, it shows you what is taking place. You have the trade and the option. You click on the option and the chain comes up in a similar manner. So we have single option, so you can choose a strategy or a combination thereof. All right, and the calls and the puts are similar. The strike prices are the same. So you just have to know how to read the different chains. And it tells you times 100, indicating that there are 100 of the stock in the contract. So this is the option chain. And let us just go quickly and search APLD and see what it is doing at this time. APL APLD. All right, so apply digital. So this is currently trading at $34.42, or let's say $33. So we have an idea as to what is taking place, and we are already in the option chain. All right, so if you want to engage in any of these practices, feel free to utilize the links in the description below so that you can get access to these platforms. And the reason I'm recommending them is because for a new person, they are fee free. All right, you have to pay a small fee towards the institution which regulate the regulatory body, SEC. But other than that, the platform itself does not charge you any fees like the legacy brokerage. All right, so this here is more geared towards younger persons, persons who don't have a lot of capital, and persons who actually want to move ahead using strategies, can take more risk, can try more times, can fail more often, so that they can learn and put themselves in a financial position of abundance. So these are just some things that I want you to bear in mind so that you can appreciate the concept of option market, the option mechanism, the option structure. All right. Now, let us get into the Word of God. It says in 1 Corinthians 14, verse 40, let all things be done decently and in order. So, reading an option chain properly is a matter of order, structure, and discipline. So we have to position ourselves to do that which is right, do that which is righteous, and make sure that we are taking the best and most advantageous positions that we can take under the circumstances of the knowledge that we currently have. Now, let us get into the conversation of the intrinsic value versus the extrinsic value. So when you look at the option chain and at the option premium, the price that you pay, it composes of two parts, right? So it has the intrinsic value, and the intrinsic value, basically, this is the part of the option premium that is in the money, the amount by which exercising would be profitable immediately. So, we talk about in the money, we talk about out of the money in the last sitting. All right, so if it is in the money, then the intrinsic value means that this is the value that it have if you actually exercise at this juncture. So if you buy a option contract, let's say you look at SoFi and it is trading at about $30 and you have a call with a strike price of $5, then the intrinsic value would be 30 minus 5, which would equal to $5. And you have one contract which comprise of 100 shares counts. So you're gonna type 5 by 100 and then you will have $500. So it's that simple for us to understand. But let us look at it now. If you pick a contract, an option that is out of the money, which means that the price has not yet been reached, so the strike price is above the current price, the intrinsic value is 0. So if you execute it now, you'll be basically giving away money, buying something more expensive than it actually is. Now, that value is important when you have positioned yourself appropriately, and you want your options to expire in the money if you want to be assigned. But if they expire out of the money, guess what's going to happen? You are not going to be making any money on that option. Now, let us get into the extrinsic value. So when we talk about the extrinsic value, this is the portion of the premium above the intrinsic value, which accounts for the time to expiration. It accounts for volatility in the market, interest rates, and other factors. Also, it is called sometimes time value. All right. Let us use a hypothetical situation again. So, for example, suppose the SoFi call with 35, well, 25 in the money sells for $7. The intrinsic was 5. The extrinsic would be 2. That would reflect the time value and velocity, right? So the reason we get the intrinsic to be 5 is because we have it at going for $30, correct? And it's at 25. So the value that it has is that $5. Good. And the extrinsic, accounting for velocity and all the movements in the market, is the additional $2. So that is how we got the $7. If you had an out of the money option, example, let's say SoFi strike at 35, the underlying intrinsic is 30. Which means that zero premium might be possible because intrinsic is 0 because it didn't reach its strike price. So all the premium that you'll be paying would be extrinsic. It's better you pay for one item once than paying 2 times for the same item. What am I saying? I am saying that sometimes it's better to pay for the extrinsic value than the intrinsic and extrinsic value if you are waiting out in the future. If you are going to do a quick play, then it is more favorable for you to buy the intrinsic and the extrinsic value. So the further out in time you are going to go, then the best option is to select an option that is out of the money. If you are closer to your expiration, then we're going to go in the money. All right. So that there's just an idea. So let's say APLD is at $34.35. A call at a strike of $30 is in the money. by $4.35. If the premium is $5.50, then the extrinsic value would be $5.50 minus the intrinsic value, which is $4.35, which would be $1.15. A call with a strike price of 40 is out of the money because the price is now at 34.35. So if the premium is $1, then the intrinsic value is 0, but the extrinsic value is $1. So that there is just something that you can bear in mind when we talk about the intrinsic and the extrinsic value. So intrinsic value is a value that you have right now. The extrinsic value is a value that is given to you from the outside, and those two go together to determine the fluctuation in an option price. So most times if the option moves favorable, both the intrinsic and extrinsic increase. But when it moves unfavorable, the intrinsic decrease and also the extrinsic decreases in a liken manner. The question you must be asking yourself is, why does this matter? What matters is time value decay. As expiration approaches, what we have is theta decay taking place. All right? So just bear that in mind so that you have a grasp as to what is happening. The more time until expiration, or the higher implied volatility, the higher the intrinsic value tends to be. So now that we have a grasp of intrinsic and extrinsic value, you can appreciate what is taking place. Now, what I want you to do is to understand that all these mechanistic designs, mechanistic approaches, helps us to understand exactly what is taking place. Understanding this helps us to assess why an option is priced as it is and what you are actually paying for. Sometimes you pay for a car and you get a lemon. You didn't buy a lemon, you bought a car. So that there is something that you need to understand. Does the car has intrinsic value? Does it have an extrinsic value? So basically that is the same thing that is transported or transferred into consideration when we're talking about the option. The biblical passage that I want to bring your mind eye to is Proverbs 27 and verse 23. It says, "Be thou diligent to know the state of thy flocks, and look well to thy herds." Understanding both parts of the intrinsic and the extrinsic of an option means being diligent is knowing exactly what you own. So when you own something, you need to know what you own, why you own it, and understand it in as much detail as possible. Many persons, when they buy a product, they just start using it and forget that the product came with a manual. Now, the next section of our conversation is going to be surrounding bid ask spread, volume, and open interest. Now, when we consider the bid ask, the bid is the highest price someone is willing to pay for the option. So if you are a buyer and you're bidding, it's just like an auction. So someone says 1 cent, someone says 2 cents, someone says 3 cents, someone says 4 cents, and it goes up till it reaches $1. So the bid is the highest price that someone is willing to pay for an option. And the ask price is the lowest price that someone is willing to pay for that said option. And the last price that we normally see is the price many traders feel comfortable paying, and that there is a last price that is reflected in the last price listing. All right, so let me just get you on our screen so that you can see exactly what it looks like in the real world of having a real life option trading taking place. All right, so you can see the bid ask spread. Now, as we are waiting to load that screen, let us move to the spread. The spread equals the ask minus the bid. So that there is a difference. Just like when you have currency exchanges, like in the bank, they'll buy for one rate and they'll sell for one rate. And in the middle, they are making profit. So whether you buy or whether you sell, they are still going to make a profit. That there is the spread. So it is a narrow, if there's a narrow spread, means that there is better liquidity. A wider spread means it is costlier to enter and exit that position. So just be mindful of that when you are examining the option chain. So once again, let us engage our recording sequence so you can see exactly what is taking place. So an example is, say suppose SoFi calls shows a bid ask of 2.3 or $2.30 and the ask price of $2.60. The spread is the difference between the ask and the bid, or the bid and the ask, and that there would be about 11 to 13%. All right, if a contract has a bid of 0.4 or 40 cents and an ask of about 100 cents, the spread there is a big spread. That spread is 0.6, which would be 150% spread. So it's a high cost and poor liquidity position. So you want to ensure that any position you're getting in has sufficient liquidity. So now that we are back up, let us go back into our option chain, and we're looking at SoFi in this instances. And we're just going to pull up a random date, let's say November 7th. Let's pull up November 7th, which is 2 days away. And we're seeing the limit price, that is the price that we want to pay. We're seeing the bid, we're seeing the ask, and we're seeing the middle price. So the middle price is the average where the buyer and seller can come to an agreement if either of the price is not. All right, so that there is something for us to note. But now let us look at the actual option chain and the different strike price. You see ask price. Right there we have the ask price. All right, and when we touch it, it takes us to the bid price. All right, if when you touch the bid, it takes us to the bid price. When we touch the ask, it takes us to the ask price. So these are some things that you need to be mindful of and be aware of. So we understand the bid, the ask, and we understand the spread. Now let us examine the volume versus the open interest. So the volume is the number of contracts that were traded today. All right, the open interest of a contract or of the whatever it is that you're doing is a number of contracts that are currently outstanding, which means that they are not yet closed or exercised for the strike price and the expiration price. So let us see if we can look at the open interest. So if you do a little mathematical calculation, you can come to a conclusion as to how much contracts needs to be closed, how many persons are still holding on to their positions. All right, so in some areas you're going to see zero, some areas you're going to see a number that's bigger than zero. So the open interest is basically the number of contracts currently outstanding that are not yet exercised or closed, right? And some persons allow their contracts to expire worthless. So as we come closer and closer to out of the body, we see a lot of persons having different amount of open interest. All right, we're seeing 0, we're seeing 6, we're seeing 15,366, 35,032 strike price, So those persons 37th it's so many. So these are all the contracts that are still outstanding, and this is a real-time view of what is happening. All right, and the volume is how much is traded today. So if we look at the volume, we can see 1, 1, 2, 2, 0, 0, 0, 0, 0, 0, and it goes on. Then we have 17, and then closer to at the money or in the money, we have the numbers increasing. All right, so that there is something for you to understand. High open interest plus a decent volume equals basically better liquidity and more certainty of a fair price. So when you have adequate buyers, adequate sellers, you are in a position to assess the situation and realize that you're getting a fair price. Example, let's take hypothetically for APLD, you might have an open interest of 2,000 contracts at a strike price of maybe 30, expiring at X date. If the volume today is 50 contracts, that tells you how active the strike is. So that there is just something for you to ponder. All right. So speaking of APLD, let us take a look at APLD. Let's go and let's search for it. APLD, and you can just type it in your brokerage account and it will tell you the actual price. I will leave the links as always to these two brokerage accounts that I have found to be very beginner friendly, and they are Webull and Moomooo. Currently we're viewing it from the Webull platform. All right, so now let us look at APLB, the options, and this is a good company that you could consider to invest in, but I can't tell you to get involved in this company. So we are looking at the bid ask at 32 strike price. We're just going to take 32 strike price so that we can have a visual representation of the theory with the practical. So we have a 32 strike price, that's a number in the middle with a dollar sign. And if we look at the bid and the ask, we are seeing the bid is $1.18, the ask is $1.49. The last price was $1.30. All right. Well, now let us look at the volume. The market just opened about 50 minutes ago. The volume is 214 of these have been sold since the last 15 minutes. All right. The open interest, how much contracts have been made at this strike, is 1,127. We're looking at the implied volatility of 134.36. All right. So just bear that in mind. And this here contract was for November the 7th, 2025. So if you look at that, you can see even the graph of this particular contract. And let's click on it again. Let's click on it, the 32. Let's see if we can get that graph. And it tells you exactly what is happening. You can go to the 5-day, 1-day, 5-day, and it gives you a basic idea. When you do it on the computer, you can see it a little bit easier because there's a bigger landscape for you to enjoy. Now, so for a real world example, for SoFi, you might check the chain expiration, let's say November 21, 2025, the strike at 35. Let's go to that and see what that would give us. All right, so let's go back to SoFi, and we're looking at November 21. We're not issuing a buy on SoFi for November 21, but we're just using this as an example. Now let us look at the strike price of 35. So the strike price of 35, we have let's go to 35, and we have a bid of 0.35 and an ask of 0.41, and the midpoint is 0.38. So the difference would be the spread. So 0.35, we're going to take that away from the 0.41. which would give us approximately 0.06. All right, which is reasonable, and this is fairly priced. And if we do the same thing for APLD, we can get a similar action so that we can compare exactly what is happening. So let us look at the open interest in this position. So at 35, open interest is 13,020. All right, that's open interest. So that is the amount of contracts that need to be closed. Those contracts have not yet been exercised since morning. Since the last 16, 17 minutes, this contract has sold 87. That is phenomenal. So you are getting a very good insight as to how the market operates and how the market moves. Why it matters. If you pick an illiquid contract with low volume, low open interest, or widespread, you may pay more than the fair value or have trouble exiting if you need to exit. All right, so understanding the bid and the ask and the spread helps you to plan your entry and exit and know the actual cost. So the biblical insight that I want us to focus on is Luke 14 and verse 28. It says, "For which of you intend to build a tower, sit it not down first and count the cost." So counting the cost includes checking liquidity, checking the spread, checking the market structure before making your trade. I want you to know and understand that before you enter a trade, you must have your exit plan. Before you enter a trade, you must have your exit plan. Your exit plan is going to save you. So bear that in mind and use it to your advantage. Now, let us move into another area of exploration. So we want to understand the stock as we explore the option. So we're going to be using example stocks to walk through the mechanisms, all right, or the mechanistics of the options. All right, so let's do it. Example with SoFi. Let's say that it is trading at $30 underlining. That's the price for SoFi at this time. Just hypothetically saying, we'll go to the option chain for SoFi. We're going to pick the date, assuming the 21st of November 2025. We're going to pick a strike of 35. We're going to select a call that is out of the money. It is out of the money because the underlying price is 30, but we are saying that it's going to go to 35 and beyond. So we're going to pick that out of the money. So that is out of the money. Or if you feel very confident in your positioning, you can go to the 25 call, which would be in the money. So with the in the money, you know what you're going to be paying for. All right. So now, if the strike is 35 and the underlying is 30, the call is out of the money, which means that there's no intrinsic value to the contract that you are buying. So the intrinsic value would be 0. Suppose the premium is about $2.50. The extrinsic value would be $2.50. And then in order to calculate the break even, you're going to add the strike price plus the premium that you paid, which would be 35 plus $2.50 would be $37.50. Simple as that. Beautiful. Now let us examine the other example, which is in the money. So if the strike is 35, the underline is 30, the call is going for $5 in the money. The intrinsic value, let us reason this, is, what is the value of it? The price is at 35. No, the price is at 30. And the strike is at 25. So the intrinsic value is that $5 right there. So the 25 taken away from the 30 would give us $5. So that there would be $5 in intrinsic value. All right. So suppose that this premium is $7. What you will realize is that we already have the intrinsic value at $5. So the extrinsic value would be taking the 5 now from the $7, which would give us the $2. So the extrinsic value would be $2. So if we want to calculate the break even for this, we're going to have to take the $25 strike, add the $7 to it, and then we are at a number of 32. So 32 would be the break even. So if even though you're buying it at 25, it has to reach to 32 for you to break even. If you're going to allow it to expire, you can trade out of it, yes, but if you're going to sit in it until expiration to be assigned, it has to reach 32. So you have to check the bid ask. So suppose the bid is $2.40, the ask is $2.70. The spread is going to be 0.3, which would be 30 cents. So you're going to check the volume and open interest. So let us hypothetically say the open interest is 500 and the volume is 120 today. That is relatively good liquidity. So decision making is important. So if you're bullish and expect SoFi to go well above $37.50 by expiration, the $35 call might make sense. Lowering costs, higher in leverage. But if you expect modest rise, the $25 call might be safer. So it's like an intrinsic cushion. So we have to also consider the risk when we are engaging in these type of activities. So if SoFi stays below 35, you lose your 250 times 100, $2.50 times 100, which would be $250, right? The time value decay volatility could drop. So that there is something to be considered. And we can do this with other stocks. So you can pick a random stock that you think has value and do the same type of calculations in that stock so that you can be aware of the possibilities that exist. Now, we can do a comparative observation. The out of the money option costs less but needs a larger move to profit. So there's a higher risk and a higher reward. The in the money option has more intrinsic value, less leverage, but costs more premium. So break even is closer, risk may be lower, but the upsides may be smaller. Liquidity differences between SoFi and APLD may affect ease of trade, spread costs, and likely price efficiency. So if you are exploring to buy an option, I need you to understand these fundamental principles so that you can make a strategic positioning before you execute on that play. Now, let us move into another section that we think would be prudent for you to understand. And these comprise other mechanism or other mechanics to be considered when dealing with option trading. All right, so theta or time decay. This is very important, especially if you are a buyer. If you're a seller, theta is in your favor. If you are a buyer, theta is not in your favor. So As the expiration approaches, the extrinsic value declines. So that's time decay. Example, in our SoFi 35 call, much of the $2.50 premium is extrinsic. It only If only 2 weeks remain, perhaps extrinsic drop to $1. So premiums might drop to $1 even if the underlying is unchanged. And the reason for this is because there's no intrinsic value. So you're losing money on the extrinsic, right? So traders need to factor this into their strategy. Time is working against long option buyer. All right, so bear that in mind. Let us examine implied volatility, or IV. IV is market expectation of the underlying future volatility. So a higher IV, implied volatility, means higher premium because extrinsic value increases. It's all being equal. And let us put APLD on the spotlight. Suppose APLD has a high implied volatility due to anticipation of news, earnings that cause premiums to be higher. Even if the underlying does not move, implied volatility drops, sometimes called volatility crush, which can reduce your premium and reduce your profitability. So you don't want to buy a week or two into earnings if you realize the implied volatility is spiking. You want to be strategic in when you enter, and you have to be patient so that you can wait and have no problems in waiting. All right, so if you position yourself like that, you will be in a good position because your mind is where the game is being played. Liquidity. When you get into something, you want to be able to get out of it. You don't want the stock or the company to go bankrupt or bust if you're a buyer. If you're a seller, you don't mind if it goes bankrupt or bust because you're getting your money anyway. But it all depends on where you are and if you're buying calls or you're buying put. If you're buying puts, if the market goes bankrupt, then you're okay. So you have to just bear those in mind. So liquidity and execution of the risk. So wide spreads or low volume open interest may mean you entered at the worst possible price or you cannot exit. That there's something for you to bear in mind. Example, if APLD strike is 40, the call has a bid of 70 cents. The ask is $1.40. The spread is 0.7. That is large. Entering might cost you more. Exiting might cost you more too. So you have to weigh the balance, count the cost, and see if this risk to reward is even worth it. Let us look at the break even. Most apps like the Webull and the Moomooo, they have different break-even calculations, and they have the lines on the graph to show you when you are breaking even, especially when you enter the option contract. So they will help you. Moomooo will help you even more. They give you exactly when you'll be breaking even. For the Webull, you have to do some analysis visually to figure out exactly where you're going to break even. But if you don't want to rely on a platform to tell you where your break even is, then you can know how to calculate your break even. For a call, break even equals the strike price plus the premium. For a put, the break even equals the strike minus the premium if you're long the put, right? So that there is a simple nutshell as to break even if you're going to allow it to expire on you. All right, so just be mindful of that and know where the stock needs to be so that you can be profitable. So example, SoFi call strike 35 plus a premium of $2.50. The break even is actually $37.50. All right. So let us look at APLD. Say, for instance, APLD, I put the strike price is 35. The premium, you're going to subtract the premium, which is $3. When you do that, you have 32. So your break even, once it falls to 32, then you'd have broken even. So you just have to know how to navigate these things. So maximum loss from a long option equal paid premium. Maximum gain from a call equal potential unlimited. Maximum gains from a put equals the strike price minus the premium if the underlying goes to 0 times 100 shares. Sellers have a different risk profile, often higher risk, but we will cover sellers in a later module. The insight I want to leave with you biblically as we wrap this section up is Proverbs 21 and verse 5. It says, "The thoughts of the diligent tend only to plenteousness, but of everyone that is hasty only to want." So take time to understand these mechanics. This will help to ensure you're diligent. This will put you in a position so that you don't have to rush into something without the knowledge, which often leads to loss. Ignorance is a very costly endeavor. I don't want you to be ignorant. Now, let us move into exercise and a reflection. So practical exercise you can do is to, as we did previously, is to go to an option chain. Take one of these platforms, go on the option chain today. Choose one expiration date, about 4 to 6 weeks at minimum, all right? You're going to pick two strike, one out of the money, one in the money for either call or put. You're going to record the premium bid ask spread, the volume and the interest. You're going to calculate the intrinsic, you're going to calculate the extrinsic value of both. You're going to compute the break even manually. You're not going to use the calculation that is on the phone or on your computer. You're just going to do it manually, so as you have a working knowledge as to how this thing works and operates. You're going to take an image of the two scenario, underlining the move of 10% or underlining move of minus 10%. What happens to your option intrinsic value and what happens to the extrinsic value? So you're going to have a qualitative recipe for a vibrant discussion. Now, you're going to reflect on which option would you have chosen, knowing what you know now, based on your risk tolerance, the movement expectation, and the liquidity. All right? So if you do that and you are successful in doing that little exercise, then you are getting yourself familiar with the option chain and how it works. Luke 16 verses 10 through 11 says, "He that is faithful in that which is least is faithful also in much." I want you to be faithful to yourself. I want you to do what is in your best interest for not only yourself, but also for your family. While you're reflecting on what we have done, I want you to write a paragraph about how small contracts, small spreads, careful liquidity checks are little things being faithful in builds towards bigger trade carefully, and this will guarantee to a greater degree you becoming a successful investor and a successful trader. I want you to just ponder in your mind just momentarily, Why might an option with a high strike, more out of the money, cost less but be riskier? Why might an option closer to in the money immediately exercise costs more but offers a different risk reward profile? Use SoFi or APLD, or if you have a particular stock that you have been watching, you have been eyeing, feel free to use that and tell us what you're thinking in the comments below so we can have a vibrant discussion. The takeaway that I want you to bear in mind is simply this: an option chain is your roadmap. Learn to read it carefully. Premium equal intrinsic value plus extrinsic value, so you need to know both. Liquidity matters. We need to understand the bid, the ask, the spread, the volume, the open interest. All impacts, all of these impacts the cost to exit and to get into the contract. Time, decay, and implied volatility significantly affects our extrinsic value, especially as expiration draws near. Using real world example like SoFi, APLD helps you to link the theory with actual markets. Biblical wisdom reinforces diligence, order, stewardship is how you approach your trading, your investing. With that said, I hope that this information was profitable to you and you will do with it that which is reasonable and feasible. In our next sitting, we're going to be considering option Greeks. So we're going to be talking a little bit more extensively about the delta, the gamma, the theta, the vega, the rho, plus the biblical parallel with all of these. So thank you for spending this session with us. We hope to see you in the next session as we complete the whole caveat of the options trading as it relates to the stock market. Remember, God desires for your life to be better and not bitter. Be blessed and have yourselves a money filled day. Until we meet again.